Hello again, everybody. Thank you for joining us. I hope you didn't miss the beginning of this webinar because of my bad on announcing that in the last webinar that it was going to start at 9:30. Actually, I'm all screwed up with the time because of the time zone. I'm in Central Time Zone. I keep forgetting that we usually post everything in the Eastern Time Zone. And anyhow, sorry about that. That's why I sent an email out about that saying that I messed up. Anyway. Okay. Hello, Jim.
Hello, good morning. I want to show you a couple of things. First of all, I'm going to mark, here's the settle. This line right here represents yesterday's settle. Notice on the low here on the 20th that there is no excess on that low. We did get a little excess right here, but there's no excess on this low. The reason this I mentioned yesterday, this has been the most unusual market that I have ever been involved in. And the reason for the unusualness, I believe, is a couple of factors. One, an estimated over $100 billion of new trading money, new money, a lot of that trading money that has come into the market. First time traders, the stay at home, and of course the pandemic, and then the government, putting in the both fiscal and monetary policy, putting money into the system, which is probably equivalent to, 3 years of GDP. So you look and you hear us say, well, excess, the most important thing we deal with, and yet there is no excess on this day. And the market from this day went up 1, 2, 3, 4. You can see all how high the market went. And there were days along the way where there was no excess either. Here's a day there was no excess. And now the market's come back, and it has come back and taken out a lot of that excess. Now, that is very frustrating, because what happens when I talk about the importance of excess is you get it in your mind that the market can't go up because there's no excess here, and yet the market went substantially higher. What has been going on in this market has been absolutely crazy, and this is what you read about in the news, where they took stocks like AMC and things like that, and they just craziness. And usually when those people do those things, they pay for that in the long run. But so again, this is really the confusing part of what we talk about, this ability to be mentally flexible and understand what's going on in the market. Because here we told you about excess, and there is no excess. There's a gap in here, and yet the market went substantially higher. However, the market did come back and repair or take out a lot of that excess. Now, that may not be meaningful if you're a short-term trader. So what I want to focus on right now is I don't change anything about the importance of excess. However, as a short-term trader, the most important thing that you deal with is value. Value will keep you out of a lot of trouble, because we will have these things, this craziness that goes on in this market. Don't let this bring you to, if you don't get excess, don't let it bring you to a standstill. Go with the development of value. Value will help keep you sane in these markets. Next, because it's current right now, I'm going to go to a bar chart. And the first thing I'm going to do is I'm going to go to a monthly bar chart. And I want to draw a bigger picture of what is going on in the market and what you have to deal with. Over on the far left, it doesn't go all the way back, but for 14 months, the market on a monthly bar chart, one time framed higher. This was following the Trump election, the market one time framed higher. Markets go from trend to trading range, and then from trading range back to trend, or trading range and reverse. So the market goes higher for 14 months, one time frame higher, strong trend to the upside. Then for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months, or 13, the market moves sideways in a trading range for a year. Then the market, it still stays kind of tight range, tries to go higher. Then you get this big break with the pandemic. So the first thing I want you to know is we generally go from trend to trading range. It is extremely rare that we go from bear to bull, which is this market did. Extremely rare. What happened in this case was intervention, both monetary policy and fiscal policy, as I said, that artificially added what equivalent to 3 or 4 times yearly GDP to the market. So then the market, more recently, been 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 months, one more time, the market one time framed higher. It is very important that even as a short-term trader, you always look at these charts to have a general idea of the overall trend in the market. You want, no matter what short-term stuff, you want to generally have your trades in the direction of the trend. That is going to be your safest thing. Now, what happens is you get biases. You get biases, you listen to commentators, they tell you the market's no good, and they talk about inflation, and you let those biases seep in. And I know a lot of people have been shorting this market for a long period of time, and they've lost an awful lot of money. Now, and what I'm getting to, so back here in, what month was this? Would have been, is that October? No, what month is that?
That can't be October. Maybe can
No,
you
it's,
switch it?
let's see, this is December, October,
No,
November,
no, December, November,
December, November, October,
October.
September. Okay, so in September, we had a change in the market. So after 11 months of one time framing higher, then we saw the cessation of one time framing. And remember, one time framing means that this bar did not take out the low of this bar did not take out this low, etc. One time framed higher. When you see the cessation of one time framing, that is usually an indication that change is underway. Markets generally do not go from bull to bear. They go from bull to trading range. The market now has entered into what I believe to be a trading range. Okay, so again, I just, it may continue higher because they're still putting money in, but I just want you to have a general overall feel. This was the first indication of change was when the cessation of one time framing, then, markets don't give up easily. They're buying every dip. But now we've got a market that is showing us something different. Markets generally go from trend to trading range. What I put out last weekend I do a one Twitter post on the weekend. And what I tried to raise, the issue was the likelihood that the market was entering a trading range. And that trading range, very often, what happens is the left-hand edge of that trading range, and I'm not going to go to a daily bar, very often, the left-hand edge of that trading range is established via some non-linear moves to the downside. And when I use the term non-linear, I mean that just a little bit of force can take the market lower. You saw a crazy move to the downside yesterday afternoon. And that crazy move to the downside was a non-linear move to the downside. I believe that is consistent with what I put out Sunday, that this is a market that is coming into short-term balance. And that means we go from trading range, we go from trend to trading range, not from bull to bear. Too many times we overreact. My guess right now is the market is setting up a trading range. All right, I just wanted to, because we had some days with no excess, that excess, the lack of excess on those days, even though the market went higher, alerted me to the probability that the market was getting overdone by these crazy buyers out there, something I've never seen before in the market. I've seen some craziness, but I've never seen anything quite like this. And as traders, you have to deal with it because that is reality. But the odds were building that the market would start to move sideways and go into the trading range. And what I think is going on right now is the market is forming a trading range. All right, I got off track, but I got off track because this is what's going on right now. Jen?
Okay. Somebody's asking, could you explain nonlinear move again, please?
A nonlinear move just simply means that a tiny bit of force can send the market catapulting lower. That's all it means. It's not like, this huge force. Just a little bit. It's just like, when you play pickup sticks or whatever, that stick where you stack and you pull one stick out and the whole thing collapses. That it takes very little to start things in the opposite direction. Okay, let's go back to the slides, unless there's a couple of big questions.
So somebody's just asking, so do you mean like some news could do that?
No, it doesn't have to be news. Sometimes it's news and sometimes it's not. Sometimes it's just the market, it just gets so far ahead of itself and it just starts to come apart. It just can't sustain itself anymore. And this market has been, when you look at the daily market, when you see this right here, these tiny, very thin, narrow trading ranges, and anybody that's been in any of my courses, I've heard this before. When you get these narrow trading ranges like this, very, very often this is an indication that the market is just getting way, way ahead of itself. And usually this is taken back in a non-linear move. And take a look at how much in just a couple of days, all of this is taken back. Look over here. You see the same thing right here to this market, the same craziness right here. And then in 3 days or so, it takes all of this back. Very, look at this formation. The market just got, people would rather buy, and they get crazy and they buy every break. When I put out anything negative on the weekend post or add something about the caution, I get negative response. And people says, oh, he's just a scaredy cat. And But people don't, they don't want to hear bad news and, or the reality. And you don't know. I mean, because the money was made, as long as you were prudent, the money was made by being on the long side and being aware. But you see, this is very similar to this and this is just craziness, gets overdone. And then it moves sideways in here. And then it takes all of this back in just a couple of days. Again, it's just something to be aware of. This is what markets do. So much important, if you're going to be a successful short-term trader, is being able to have a clear perspective, get rid of the biases, do your own homework. And we're going to show you more about doing homework and how to keep things in perspective. Okay, one more question, and then we're going to go to the scheduled program.
Okay, so an unusually large move compared to the previous ranges, stair step up or elevator down?
No, don't. It just look at yesterday. Yesterday was a nonlinear move to the. It took very little, and that market just collapsed. That was a perfect example, and don't try and relate it to another day or anything. It doesn't happen very often. This didn't this, but here, there's a nonlinear move right here. Very little action takes all of this back. Very little action takes all of this back. The market just got so far ahead of itself, and all of a sudden it collapsed of its own weight. Okay, let's go to the scheduled presentation, please.
Okay, 1 second.
Okay, review. What is the market profile? It is a time-sensitive, evolving database. What does it do? It organizes the evolving data from the two-way continuous auction process. What do we do with the data? We use it to develop probabilistic trading opportunities. The edge, they say so often, to be a successful trader, you have to develop an edge. The edge, in my opinion, is being able to think in terms of probabilities. That is not something as people we do naturally. We have to learn to think in terms of probabilities. Okay, next slide. We talked yesterday, I believe, about the dispersion model. In the tipping point, how little things can make a difference, Malcolm Gladwell defined the way people react to change by classifying them on a spectrum. Let's take it from the low. Let's say the market starts up. First, you get an innovator. Now, a lot of times you don't see the innovator. The innovator may be in excess, but the innovator usually doesn't show themselves. They do everything to hide what they're doing. The next people that catch on to what's going on is the early adopter. Early adopter, and then you get the early majority, the late majority, and finally you get the laggard buyers or sellers, depending on which way the market is going. In this case, we took the market from low to high. So you go up to the point where you get the laggard buyers. Now, this happens on a large basis, and it also happens on the smallest basis. It happens in the day time frame. It happens in what we saw this recent break is really, the market coming apart on the longer basis. But the same concept happens on the day time frame. It's just dependent on what time frame you're trading. But if you can think in terms of what's really going on in the market. Are you innovator, early adopter, early majority, late majority, laggard? That will help you keep perspective. What happens to us as traders? We get too carried away and we get caught up in all this enthusiasm of price going higher and lower. If you can think in terms of who's involved, are they the laggards, early majority, late majority, it will help you keep a better perspective. Next slide, please. I find the market profile to be most beneficial at both ends of the dispersion model. You get, when the market goes too high or the market goes too low. I find at those extremes, because usually you get the laggards taking it up and you get the laggards taking it down. And usually the market is, it's less reliable at that way. It's more panic. If it's going up, it seems like the market could never go down again. If it's going down, it seems like it could never go up again. This is just the extreme. That's when the laggards get in and everybody is just taking it up or taking it down. That is usually the end of the move. But this idea of thinking in terms of the laggards, the innovators and the laggards at both ends of the spectrum, I find to be very meaningful to keeping me mentally on track. Let's look at the next slide. Where do I find both of them in harmony? The early adopter, early majority, and the late majority. The real money for you, for me, as short-term traders is in what I call the sweet spot, the early adopter, early majority, late majority. This is when everything's moving together. There's harmony in the market. It's the easiest time to make money. If you can keep in mind that this is what's going on, it is much easier to keep on track. Be very, and what happens when you're in it, so many times people lose money in this sweet spot because, for example, if the market's going up pretty sturdy. And then they start to say, oh boy, I think it's too high. Or they hear somebody talk about the market and they start bringing in some economic thought and they go short the market. And the market's going straight up because you're in the sweet spot, or it's going straight down. Keep this in mind because most of the damage we do to ourselves, we do because of biases slipping in, and cognitive dissonance. Listening to somebody rather than listening to yourself and learning to read and interpret the market. What we're trying to do by going through what we look at here is use market-generated information to make the best probability-based decisions on trading, rather than listening to somebody, on the TV or somebody that's, sounds good. They may sound good, but they may have a totally different time frame than you do. They may be right in the long term, but they may be dead wrong in the short term. Learn to read the market. Learn to depend upon yourself. 2 days ago, I went to get a haircut. The young guy cutting my hair actually does a good job cutting the hair. His mother owns the shop, but two of his buddies are in there for haircuts, and they're talking about the market. These are young guys, and they're going to make a fortune in this market. They're going to make a fortune. And boy, this market's never going down again. And one guy says, well, how much you got to invest? Well, I don't have any money invested right now. I lost my money, but I see where this market's going. And just the craziness. There was no thinking other than, oh, they're listening to some commentary. Oh, I listened to so-and-so. So-and-so's got some really good calls. They're nothing that they're doing on their own. They're listening to somebody else. And there's so much of that out there, you can't believe it. The real dependence is when you learn to read the market and you make your own decisions. Let's go to the next slide. Time frames. Day time frame, short term, intermediate, and long term. The day time frame is really what we are talking about in here. Most of us are day time frame traders. But to be a good day time frame trader, you want to start, when we read the bar chart, you want to understand what the long-term time frame is doing. So if the market is going higher for 11 months in a row, it's one time framing higher. When the market starts to go into a balancing phase, which I showed you where the market moved sideways for over a year, that's really the intermediate term time frame. So you went to the long-term time frame, then the market moved sideways for a year. That was your intermediate time frame. Within the intermediate term time frame, you will get short-term trends up and down. Within the short-term trends, you will get day time frame trading. Sometimes the day time frame trading is with the short-term trend. Sometimes, it's fading that as it's coming to an end. But if you can think of the market in terms of these time frames, it will help you keep a better perspective as you begin to review the bar charts and to keep a fair and honest perspective. Look and decide for your own rather than listening to some guru. Okay, let's look at the next slide. Information is the driving force of all markets. Information has no power until someone acts on it. Understanding human nature is key to understanding the totality of the auction process. Why do they use an auction process? They use an auction process because that's the best way to attract people, use another way to suck them into the market. Remember, we did the example of the auction. We tried to get the art auction started at $100,000. Nobody would bid at 100. Finally, at 93,000, they're bidding like crazy. The next thing you know, you're up to 105, 107,000. It's that auction process. People get caught up in that. You have to understand that process, and you have to understand which time frames are taking it. You use volume and you use structure, which we'll talk about, in order to have some idea of how young or how old that auction is. Right now, you got a lot of questions, but right now, put it in your mind, understand how markets move and understand the auction process and understand what we are talking about is market generated information. And we're trying to teach you how to begin to read and interpret market generated information. When I looked at that market yesterday and kind of didn't mean to say it, but I said, oh, I looked at and it was too strong out, it looked like short covering. I said, it can weaken the market. Boom. That was nothing more than information that I've looked at it for so long and it was right there. And I blurted out, I didn't mean to do that. I just did. But that's information. That's not from anybody else. It's not from some commentator. It's by looking at the market. The market generated information is real information generated by real people entering real orders. That is the most honest source of information you will come by. Next slide, please. Let's reiterate the point of control again. The point of control is the fairest price at which business is being conducted. A point of control can be interpreted as being normal, prominent, or very prominent. There is no absolute answer to how many ticks from left to right is normal, prominent, or very prominent. It is something you learn with experience, and it is always related to what is going on in the current market. Let's look at some examples. And again, this is the way you learn. Remember, this is art, not science. So Jen has given some charts just to give you an idea of what a normal POC looks like. And then you come down and you see a prominent POC, and then you see a very prominent point of control. And lots of questions. People want to know how many ticks is prominent, how many ticks is normal,
how many wide. Yeah, we get the question all the time. How many wide?
How many wide? And people want absolute answers. I don't know how many times I've had that question. It doesn't work that way. You learn depending on the particular market you're in. It will vary. That's part of the artwork of trading. But she's given you some examples here just to kind of put the idea in your mind. But again, there is no exactness to it. Okay, let's look at another slide. What can you see in the profiles at a quick glance? Let's take a look at the first or the next row. Okay. Chunking. I talked about chunking yesterday. Group together connected items or words so that they can be stored or processed as single concepts. The example we used yesterday was backing the car out of the garage. Initially, it may be 12, 13 separate steps. After you've done it for a while, it is one. It's all chunked together into one piece of information. It's all chunked together into one piece of information. The operative word when you become a successful trader or start to really learn is observation. What we're teaching you now are the separate pieces, like back in the car or the garage when you look at a profile, teaching you point of control. We're teaching you excess. We'll be talking about lack of excess. We'll be talking about elongation, talking about migration of the point of control. Early on, they're each separate pieces of information, chunks of information. As you gain experience, it becomes one single piece of information. I understand that is a very difficult concept right now, but that is how it starts to come together. It's one chunk at a time, one piece at a time, but it forms a whole as time goes on. And this is what experience is about. You can't, I have a saying, you can't push a string. You can't push experience. It takes time. Okay, let's look at the next slide.
And there's a question here, Jim.
Sure.
I'll just go back up to here. Will a balanced day always have a prominent POC?
No, it will not. You know, I mean, there's all kind of balanced days. It could be, if some may, but it doesn't have to have. It could be a balanced day, which is an inside day to the day before. So no, the answer is no. Okay. Okay. Here's some of the things you're going to see. The opening price, the first printed price of the day. And you can see, as Jen points it out, when we're using Window Trader, it's a green dot. The closing price, the last printed price of the day. The settlement, also known as unchanged. It is referred to when there is no change relative to the closing price from the previous day. Half back, the center of the daily range at any given point in time. The point of control is the fairest price at which business is being conducted. Now, all we're doing right now, we're just putting labels. We're just putting labels on things. When you look at them right here, they're dots. They're not connected. Remember what I said, the power of the brain is the interconnectedness. One of the slides we talked about yesterday. The brain stores separate information, but what really gives you brain power is when the synapses connect. It's the interconnectedness that really takes the dots and makes them form a whole. And I'm going to come back and suggest for people that are serious about becoming traders, read at least the 3 books we mentioned to understand the brain and the power of the brain. And it amazes me how many people swear that they want to be a professional trader, they want to be a profitable trader. And I ask them, have you read any of those books? And the answer is no, but I've ordered them, but I haven't read them yet. It's one thing to talk about what you want to do. it's another thing to do it. All we're trying to do here is show you how to get started. Put some ideas in your head. So much of the work is up to you. We're trying to show you some idea of how to get started. And remember, there's probably no more than 2% of people are successful traders. People won't do the work. They will come to webinars. They're always asking for, would I buy it here? Would I sell it here? But they really don't want to think for themselves. And then if you don't think for yourself, you get caught up in exactly where you don't want to be. Okay, let's look at the next slide.
Okay, and something that I just wanted to mention here, because we have it on this graphic, use the CME website for the official settle price. So like I said, the green bubble here is how a window trader denotes that, but many a time you're going to find that when you look it up on the CME website, that the number doesn't match. We always use, despite whatever our software says, because it can vary from data feed to data feed or platform, we always use the CME website to be consistent across the board. So as you can see here, and I'll put the link out in the GoToWebinar chat so that you guys can have the link and bookmark it. But like yesterday said, 4508.50 here, right here. Okay, always make sure you're on the right month and right contract, but just wanted to point that out since we had that in the graphic.
Hold on just 1 second.
And with regards to the books that Jim mentioned, the 3 David Eagleman books, we did put them in order now on the website under resources in the books link. So the first one to read would be Brain Story of You, Incognito second, and then Live Wired third. That's the order to read them in, okay?
Okay, give me just one little second here. I'm making one change.
Okay.
Okay, I'm back to you, Jen. Let's go to the next slide. Why is overnight trade important to look at? This is always an interesting subject. We've talked briefly about this before. When you're talking about overnight trade, we don't use the profile the same way overnight because there's not enough data to give it validity. But overnight trade, it's interesting, when I first started reflecting on overnight trade and talking to it about traders, it is amazing how many professional traders laughed at me and made open comments. He doesn't know what he's talking about. There's not enough business overnight to be meaningful. And that's great to me because using that information, what I have found is so many times, approximately 70% of the time, overnight inventory is wrong. And you get a counter auction or a correction relative to overnight inventory. That gives me as a short-term trader, very often, that gives me a leg up on the rest of the world. If the first selling in the morning if the overnight inventory is long, if the first in the morning is selling, well, okay, that's a correction to overnight inventory. Very valuable information. But I also know if overnight inventory is long, for example, and the market doesn't correct, there's more information that tells me that the market's going higher. For example, if overnight inventory is long, the market doesn't correct, that tells me that there's actually strength in the market. So I use that overnight inventory. Very important for me to get started as the day opens. Okay, let's look at the next slide. Overnight trade. Important references are the overnight high, overnight low, half back, and the overnight point of control. The more prominent an overnight point of control is, the more relevant it is to me. The more prominent it is, meaning from how wide it is from left to right, more prominent it is, the greater the odds that the market will return to that level. Overnight inventory, we're going to talk how it's judged here, how we actually measure it here in the next slide. Okay, again, remember, I do not look for excess on the highs or the lows because there's not enough volume to make it valid. Okay, let's look at the next slide. How do we determine overnight inventory? Anytime when it's in doubt, be neutral. If you don't know if overnight inventory is long or short, and we're going to show you how to measure it in a minute, be neutral. Because if you take a guess at it and you're wrong, it could be double against you. So unless it's clear, it's long or short, and we'll show you how to do that in a minute, then you use it. If you don't know, it's in doubt, be neutral. Okay, let's look at the next slide. For the purpose of overnight inventory, examples in this presentation, we use the settle as denoted by the green rectangular box in Window Trader. However, for trading, we always use the official CME settle that Jen talked about a little while ago. Okay, so here, when we take a look on the profile on the left, you see where the settle is, and you see that almost all of the overnight trade took place above the settle. Overnight inventory is long. Almost all of it took place above it. Overnight inventory is long. We don't make it any more complicated than that. It's either long or it's short or it's neutral. In this case, overnight inventory is long because almost all the trade took place above the settle. Now, there will be numerous questions about, yeah, but some of it sold off early. Is it really long? You can do the same thing I did when I first started looking at this. I overcomplicated and almost drove myself nuts. Nothing's 100%, but for most cases, keep it simple. You look right here, overnight inventory is long. The next thing I see is a very prominent point of control. The more prominent point of control is, the greater the odds it will be revisited. Okay.
Some couple of questions here.
Sure.
You said the overnight POC being very prominent, you said that the market will revisit it. Did you mean like during regular trading hours, I think is what they mean to ask?
I did not, let's be clear. I did not say it will revisit it. I said the odds are that it will be revisited. And it's during the trading hours on when the market opens, NYSE opening time, during the day time frame session. I did not say it will revisit it. I talked about the greater the prominence of the overnight oversee, the greater the odds it will be revisited. There is a difference in the way the question was stated and what I said. You got to be very, very careful of that. Okay.
Overnight inventory, are you referring to the previous day? The overnight inventory is the overnight trade. So like I said, like the ES does trade in the overnight. If you're trading an instrument that doesn't have an overnight, you have to make adjustments for that, right? Because you don't have overnight inventory for a particular instrument. But for the ES, we do trade in the overnight. And like I said, for the purpose of showing you an image and defining things and showing you things about the settle, although we usually use the CME settle, the official one, how it's denoted in Window Trader is this green bubble. So for the purpose of illustration, as you can see, most of the overnight trade that happened here happened above the settle. So that's why we would say in this example that overnight inventory is long, because a majority of the overnight trade visually we can see happened above the settle. Okay. Okay. Let me see here.
Now, hold on 1 second. Remember something I said earlier, and this is a throwaway for most people. It shouldn't be. What doesn't happen is often as or more important than what does happen. If the odds are high that a very prominent point of control from overnight will be revisited, and it's not revisited, that is valuable information to you. What doesn't happen very often is as or more important than what does happen. For example, if I have two traders, one a professional trader, one a non-professional trader. I asked the non-professional trader what happened in the market today, and they may give me a great description. The market was up so and so, excited, blah blah blah. Great description of what actually happened. I asked the professional trader what happened today, and the professional trader may tell me or may focus more on what could have happened than what did happen. Totally different mentality. The non-professional trader, oh yeah, here's what happened. The market was up so and so. The professional trader is reflecting on what didn't happen. Many times, what doesn't happen is as or more important than what does actually take place. Okay, next slide.
Jim, I have to take care of one thing for 1 minute. Can I give you the screen so that you
Sure.
can discuss, and then I will be right back. I apologize about that.
Okay. An example. Okay.
I've given you the screen.
Okay, so we're just working off my screen right now. Okay, so I guess we'll wait till Jen comes back to go, and we'll just kind of turn into what's going on in today's market. Let me make a change here. I've got this, I've made this too complicated. Okay, so what we're just looking at right here, I just took the overnight out of there for now. What we're looking at here is the market building lower value today, right? We've got a bounce this morning. There's several things from this morning. Look how close today's low is to yesterday afternoon's late low. There is not a lot, there's a little bit of excess here, but there's not a lot of excess relative to what went on. Notice also yesterday afternoon, and we're going to talk about this later today in today's session, but I'm going to point it out right now. M period high. It's going to, later on, we're going to show this is classified as a weak high because of its exactness, or within one tick of the M period low from the previous day. When I see this, that tells me that the selling was from here was pretty mechanical because it came from this exacting level. And it increases the odds that we will return there today. This market was down here, 45.06, all the way up to 45.68, 60 some handles, and it did that. So this, we're going to talk about this later. This is, we talked about the importance of being able to observe. First of all, you have to know what to look at. And that's what we're talking about. This would be considered a dot. We're going to talk about this later today, but this is considered a weak high because of its exactness to the low of the previous day. The odds of coming back here are very high. All the way down here, but yet the market got back there. At the same time, when I'm looking at this, there's for how sharp this market dropped yesterday, there's no real excess down here. A couple of points, a couple of ticks, not very impressive. And then we look and we say value is building lower.
I'm
now,
back. Sorry,
I got that. I'll be with you in a second. So I'm just showing you, while Jen stepped away, I'm just showing you a couple things we're going to be talking about. Value. Later on today, we're going to be talking about weak highs. We've already talked about wet excess. For how much the market went down yesterday, there's certainly not much excess to write home about. And value is building lower. All right, we'll come back to all of this. But Jen, let's go back to your charts.
Okay. Sorry for that interruption, guys. Okay. There you go. And there's some questions, Jim. Somebody was
Okay?
asking, basically, is the difference between the settle and closing price essentially just where the CME considers the end of day versus where a specific software may consider it closed?
The settle is the official settlement price set by the CME. Last trade is the last trade that took place in that last hour of trading. They may be last night they were within a point of each other. Sometimes they may be 10 points apart. Traders, when there's significant difference between them, the traders are paying more attention to the last. But that's really not for this seminar, but just to answer that question. Okay? What else?
Okay. When Jim mentions about the market being mechanical, what does he mean by that?
It will go, when I use the word mechanical, that meant it went to levels that are easily identifiable. For example, when I showed the M period high yesterday, was within a tick of the low of the previous day or previous reference, very mechanical. I can just look at it and instantly see it. I don't have to, there's no great mental thought that goes, there it is, you can see it. And when traders act from mechanical levels, that is usually a sign of weaker hands traders rather than stronger hands traders. Okay, what else?
That's it for now.
Okay. So here's an example of balanced overnight inventory. You see the settle on the profile on the left, and you see that overnight inventory traded above and below the settle. So overnight inventory, I mean, again, this is not a science. But overall, there was trading on both sides. The prominent point of control is higher, but the overnight inventory was balanced. And remember, anytime if you have to look too hard, decide if it's long or short, forget it. Just say it's balanced. Keep you out of trouble. Okay, what else?
Or just treat it as a neutral, like you said.
Yep. Example of short overnight inventory. You see the settle on the left, and you see all the overnight trade took place below the settle. And you see a prominent point of control. So overnight inventory in this case is short. Remember, about 70% of the time, there will be a counter auction relative to overnight inventory. So if overnight inventory is short, the odds are 70% we will get a counter auction. Counter auction to short overnight inventory would be a rally. If that rally does not occur, that provides information that the market was actually fairly weak. Remember, what doesn't happen sometimes is as or more important than what does happen. Okay, what's next? What is an adjustment of overnight inventory? Well, I just said, if overnight inventory is short, an adjustment to overnight inventory would be a rally. If overnight inventory is long, an adjustment to overnight inventory would be a break or selling. Okay? Next slide. What does a lack of overnight inventory adjustment tell you? Very important. If overnight inventory is long and there is no adjustment or no counter auction or no selling, that's an indication that at least in the short term, the market's pretty strong. If overnight inventory is short, the counter auction would be a rally. If that rally doesn't happen, that's an indication the market is pretty weak. So the lack of an adjustment also has with it very valuable information. About 30% of the time, there is no counter auction. But again, what we're talking about here is market generated information. And market generated information very often is of more value than the stuff you hear on the TV or from somebody, talking about. You're looking what is in front of you. What market generated information is a result of real people with real money placing real orders. Whether they're right or wrong, that's what they're doing in the market. And reading that market generated information is the most, in my opinion, the most reliable source of information you are going to be able to come by. Everything we talk about here is market generated information. Okay, what's next? Now we're going to talk about reference. What is a static reference? A static reference is that it's fixed, will not change. Examples of static references are the opening, the settle, previous day's high, low, previous day's half back, prior day's point of control. Let's look at the next slide. Was that all of the static references?
Yeah, I think that's what we did for static references.
Okay.
Priorities, yeah.
Prior day's POC, okay? And a
Correct.
dynamic reference. A dynamic reference changes as the market develops. Examples of dynamic references will be half back for today, the POC for today, buying tails and selling tails. These are all things that can change. They are dynamic. It's important when you see a dynamic reference changing, that's usually an indication there's something going on, meaningful going on in the market. But right now, all we're trying to do, remember, we're identifying dots. We're not teaching you how to use them yet. You have to identify the dots first before you can start to connect them. Okay?
There was a question about overnight trade, Jim.
Sure.
Do you differentiate between Asia and the European market in the overnight, or do you just take it all as one?
I take it all as one. It's a great question because I used to do that. I used to break it down into Asia and in Europe, and I found that, and sometimes there's just a huge difference between Asia and Europe. And I don't. For those, if I'm trading US hours, I take it as one. An awful lot of our clientele is not based in the US, and they may trade overnight. So if they trade overnight, then they may want to separate out Asia and Europe. As a US trader and trading US hours, I make it as one. If I was trading overnight, either from the US or, because I'm up and trade, and I do have some people that do actively stay up and they like to trade overnight. They find the markets more predictable. I think there's some validity to that. Those traders may look differently at Asia and Europe. Okay.
Okay, and then another question, or they said when you make the difference between Asia and Europe in the overnight, they came back and said this is about volume. I'm assuming that they were just asking, do you differentiate because the volume can be different for.
No, I don't.
No. Okay. Okay, do you want me to move to the next slide?
Yes, please. Important references. Prior day trading range. Yesterday's high, yesterday's low, point of control, half back, the settle. Again, right now, we're just looking at the references. It's all we're trying to do is what will we be looking at? As we go on, we'll try and help bring it together a little bit more. But for example, when I look at the profile that's right in front of us right now, I can look at that, and because I've been doing this for so long, within seconds, when I look at that, I see that the previous day was fairly well balanced. Now, I don't see what it looks like to anything else, but I had a selling tail and a buying tail the previous day. The market was fairly balanced. Now, when I'm looking at that, I look at today and I see, okay, we took out the selling tail from yesterday. I have no excess on today's high. Value is building, is overlapping to higher. Those are the things I I'm just giving you just an idea that as you get trained, you can look at that and see so much within, less than a second sometimes, just fractions. You look at it and you train it's like driving a car. Like driving a car. You just automatically see things. Your mind works very quickly. And this is again why it's important to understand the brain and how the brain works and how the brain internalizes information. Markets move very quickly. We talk about books. We usually do 1 or 2 books reviews during an intensive. A couple of intensives ago, one of the books we talked about was Gary Kasparov's book, How Chess Imitates Life, I think it was. And Gary, one of the things he made was one of the most powerful weapons he had was his subconscious. When I gave you an example yesterday, when Gaby and I came over the hill on the Cherry Cutoff coming from Sedona to Prescott, and all of a sudden there's a truck and a car passing a truck on the top of the hill, and we're looking at Reach probably going 75 miles an hour. We're looking at head on, and I passed the car with 2 wheels on the pavement, 2 wheels on the shoulder. I never broke a sweat. All of that took place in the subconscious. If I had to consciously make the decisions when we're coming at each other, it's probably 150 miles an hour or better, head on. I don't have time to think. It's all done in a subconscious manner. For example, I learned to drive on a farm in Illinois, on a cut wheat field, which is like driving on ice. And I could go out at an age of about 12 and drive a truck out there, spin the truck and do all kind of things like driving on ice and see what cars and trucks will do. Great experience. And a lot of that got stored in my subconscious. When you get to trading, if you have to think about every trade, it's going to be very difficult. Where you want to get to the point when you look at the market, your subconscious is helping you. I gave you the example yesterday of 2 soccer players. One soccer player being a novice, the other being a professional. Which one's working the hardest? The novice, because there's so many different thoughts and ideas going through the novice's head at one time, and the ball gets stolen from the novice considerable times because he can't make all those decisions fast enough. The professional has doing so much of what the professional soccer player is doing is subconscious, that he's reacting. He's already worked it out in his mind, and he's reacting very quickly and with very little effort. The subconscious, the reason to read about the brain is to understand how powerful our brains are. We have with us a professional baseball coach, if I remember right, 23 years as a professional baseball coach. And he introduced us to an outfielder gazes up in the air and the ball's hitting the air. And he runs and catches that ball. A computer couldn't make the calculations fast enough to go catch the ball. But the outfielder, with some training, can run under and catch the ball. But if you think about the physics involved, the ball in the air, how fast is it going? The spin of the earth, the winds, everything, how high is the ball? What's the angle of drop and everything else? A person can do that calculation with some training and run over and catch the ball. A computer can't do the calculations fast enough and go catch the ball. Our brain is extremely powerful. You have to train it to make it work for you. And an awful lot of the decisions you make as a trader, a lot of the work is going on in your subconscious, and that's where you're trying to get to. Now, there's too much information to process all at once. Just like yesterday, I looked at the market, and within a fraction of a second, I had a pretty good picture. Okay, what else?
Somebody's asking, can you explain again? They're asking, is the settle equal to the closing price?
No, The settle is the price officially determined by the CME.
And they have formulas and things like that to determine how they calculate that.
Yeah, I don't know how they do it now that they changed everything. It used to be a formula, now it's a committee or something. But that's the official price. It is not the last price. It is not the closing price. It's the official price by the exchange. Okay?
Right. And what you're going to notice, you can have data discrepancies from platform to platform or data feed to data feed. So, whatever somebody else is using on their platform, theirs may be different than yours. And so to be consistent across the board, we just use the official CME settle from the CME website. And I did put that link out earlier in the GoTo webinar chat in case you want to click on that link and bookmark it so that you have it.
And they will
Okay.
give you the settle and they will give you the last. They're two different numbers. Last night they were within a point of each other, so I only used the settle. Sometimes they're very wide apart, and they're very wide apart. I will mark both of them, and I find that short-term daytime frame traders put more reliance or considerable reliance on the last rather than the settle. Okay? Where do we stand this morning? How much time we got left? 20 minutes?
Yes, we've got 20 minutes left and I think 4 more slides.
Okay. All right, so let's go to the next slide. Examples of daytime frame references. Half back, dynamic as it moves throughout the session. The point of control, dynamic. The previous day's high or low, static. Overnight high or low, static. Early morning high or low, static. The settle is static. The open is static. Spike highs and lows. This will be discussed later. Period low when the market is one time framing higher. That would be static. Period high when the market is one time framing lower. That would be static. But you're always looking to see change. The element that offers you the greatest opportunity is recognizing change. Change is the key to successful trading. But how do you have to have some references, and a lot of these references help you understand when change is occurring. Okay, what's next?
Okay, somebody's asking, I see the early morning high or low references. What is the time window for it and how is that used?
There's no exact, but I mean, you'll take a look, and for example, this morning, take me back to my screen for a second.
I just brought my charts here.
Oh, okay.
Oh.
So, I mean, there's the early morning low, the 8 period, the early morning low, and I see how close that low is to yesterday's low. So I see the early morning low. I look how close it is to yesterday's low. That's a piece of information. More than likely, what's going on is short covering. Okay. Now, the early morning high, it didn't really give us an early morning high. The market was, was rallying high. Well, it did. Finally, in B period, it gave us a high in B period. So that would be the early morning high and the early morning low. But there's no exactness to the period in when it happens. Okay. We always want to know what the important references are for the day time frame, short term, intermediate term, long term, trend lines, moving averages. We actually look at the 50, 100, and 200 day moving average. We don't trade them, but we use them for perspective. The short term indicators, intermediate and long term, and the trend lines, we get off of the daily bar charts in most cases. That's why I always start by looking at the monthly, then the weekly, then the daily bar charts in order to have a better perspective of what is going on in the different time frames overall. And then we also will look at, from the bar charts, at the 100, well, we said the 50, 100, and 200-day moving averages. Again, I can't tell you exactly how we use them, but it's always, I want to know them to help me keep a perspective of what is actually occurring in the marketplace.
Right, and you really only pay attention to them when they're in the vicinity of it, you know. Otherwise, if it's far away, you're just keeping an eye on it so that you have an idea where it is, but you're not paying attention to that closely.
Yeah, you have to always be selective in what you're using. Okay, what else we got? In an upward trending situation, the low of the previous bar is not broken to the downside by 2 ticks or more. We've talked about this before. I don't know why people always have trouble with it. In a downtrend, the high of the previous bar is not exceeded by at least 2 ticks or more. So in other words, if it's going down, it didn't take out the high of the previous session by more than 2 ticks, by more than 1 tick. One time framing is applicable to all time frames, from monthly, weekly, daily charts to the 30-minute periods or intraday. I use one time framing quite a bit. It helps me have a better idea if, like I talked about, the monthly was one time framing higher following the Trump election for 11 months. That really helped me say, okay, the long-term trend in that perspective was up. So I basically wanted to trade with the trend. I wanted to be able to buy on pullbacks and take profits on rallies. If it was downward, it'd be just the opposite. Then I looked at, and maybe while the monthly trend may be up, but then I may look at the weekly bar, and the weekly bar may show me a counter trend. So you may have a short counter trend to the downside. And then the daily bar may show me a slightly different trend, but I'm trying to keep it perspective. I start with the monthly. That tells me the bigger trend. Then I look to see, what happened if the monthly trend, the weekly trend, and the daily trend all equal the same thing. Then it's pretty clear which way the market's going. Sometimes you'll get divergence. When they get divergence, you may be looking at different types of opportunities. Okay, what else? Here's an example of one time framing. This is kind of a convoluted example, but notice B period did not take out A period. Even though there's no excess, it didn't take out A period. C period did not take out B period. D period did not take out C period. E period did not take out D. F didn't take out E. G took out F by 1 tick. It has to do it by 2 ticks. H period finally showed the cessation of one time framing. It did it for 2 periods. And then what happens a lot of times, if the market's on a trend day, for example, and all of a sudden the market begins to, you see the cessation of one time framing early, a lot of times that's an indication that the trend is over and the market will now go into a rotational mode. And that's basically what this market did. It was one time framing higher, it wasn't a good looking day, but it stopped one time framing early, and then the market was basically rotational for the remainder of the session. Again, it's just another way to help you keep in mind what's really going on in the market. You'll be looking at, is the profile elongated? Is it truncated? Is it one time framing? Is it rotational? Is value higher, lower, unchanged? It's an awful lot of things that you'll be looking at as the day goes on. But there's just examples just to start to get a feel for what you're doing. Okay, what else we got?
Okay, that's it for the slides, but we got some questions.
Okay.
Somebody's asking how, and I'll give you the screen back so that you can go to a bar chart, but they're asking, how do you see excess in a monthly or weekly bar chart? Can you show an example of that, please? So I'm giving you the screen.
Okay, we'll start with a monthly.
And just so everybody knows, this platform that Jim uses for the bar charts, this is Thinkorswim, or also known as TOS, TOS.
Here's excess on a monthly bar right here. Here's excess on a monthly bar right here. Here's excess on a monthly bar right here. Okay, those are forms of excess. Here's excess right here. Okay. It's it's like excess would be like single prints. Now we're going to go to a weekly. So I look on a weekly. Here's excess on the weekly bar, and it's an outside bar of the downside. Here's excess on the low side. I mean, it's visible. Here's excess down here. Notice there was never any real excess on the upside. So he got down and the market continued higher. Go to a daily. Here's excess on a daily bar.
Can you make it larger, Jim? Because I'm sure it might be a little bit hard for some to see.
Here's excess on a daily bar. Okay.
Okay.
Here's an inside bar. Here's a little excess from yesterday, but not much. Here's excess up here. Okay.
Okay. And then somebody's just asking, since they see it here on your charts, do you still use a dollar index?
Oh, I look at the dollar index. I don't trade the dollar index, but I look at the dollar index to see if it's doing anything that could create a problem. For example, we were doing an intensive and the dollar index was down in this level right here. And if it broke through this level, it might spill over and have an effect on the ES. And it traded there for like 5 days, but it never broke through this important level. And then, it didn't affect the market. So I do look at it just to see if it's changed. I don't trade the market based on the dollar index. I don't trade it based on anything else. I do look to see if there's some significant change. It could go to a significant different level. Okay, what else?
Okay. Let me see. Okay, so here's some questions that aren't exactly related to this material. I mean, they are and they aren't. Okay, somebody's asking, how do we take this information about excess on the bar charts and apply it to small time frame trading?
Well, you look and see, okay, if you've got lower excess on the monthly bar, on the downside and it's going up, well, generally that's one indication that the market's heading to the upside. Generally, you want your trades to be, the majority of your trades, you want to be with the trend. And the excess marks the end of one auction and beginning of another auction. So you've got excess on the lower monthly bar. That gives you indication that the trend may be to the upside. So it's not perfect, but you want to generally make sure most of your trades are with the trend. And there's no exact answer to your question, but you want to have a feeling for what is the market doing on the longer term? What is it doing on the intermediate term? What is it doing on the daily? You want to have some, and you use the monthly, weekly, daily to give you a perspective. And you look at the perspective, and if there's a trend and they're all in line, you generally want to trade in that direction. And if you're going to trade against the trend, you want to be right, and you want to be right very quickly. Okay, what else?
Okay. I see that I'm developing a bias for the ES, and simply because I see it more often than other markets. But when I do my cross analysis post market, I see that there are literally multiple opportunities to trade. What are the ways to balance out that bias that Jim recommends?
I'm sorry, I'm not understanding the question.
I'll read it again, and like I said, this person who wrote this question, if you can also just write some more clarification as to maybe what you're specifically wanting to know, that would be great. They said, I see that I'm developing a bias for the ES, and simply because I see it more often than other markets. But when I do my cross analysis post market, I see there are literally multiple opportunities to trade. What are the
I
ways
don't
to
know what
balance
I
out
don't know
that
what the
bias?
term cross analysis means. I'm not familiar with the term.
Okay.
I,
Come back to us and clarify that. Um, okay. Somebody's asking, how does the dollar index affect the ES?
I shouldn't have gone there. It only really impacts the ES, well, on a long-term basis. And again, now we're getting into economic policy. On a long-term basis, our multinational corporations, our bigger companies do better with a softer dollar. However, if all of a sudden there's a cratering effect in the dollar, that may be a sign of losing confidence. Trying to do a correlation, an exact correlation, is going to drive you nuts. All I'm looking for is if there's some area that it makes a recent new high or new low, which may cause other ramifications, and it may have a spillover effect, I will look. For example, if the dollar hits new lows and it's cratering, that may be an indication that the world is losing confidence in us, and it may cause some selling in almost every asset, in every asset class. But again, don't. I'm looking for something that's unusual, and as long as it's looking pretty early, that's all I do. I don't pay any attention to it. Okay.
Okay. Somebody asked, I'd like to know if Jim takes a certain maximum amount of time into consideration for the correction of overnight inventory or revisiting uh, a point of control in the overnight, etc.
No, I do not. I'm looking to see. You're doing a lot of this on the fly. Market opens in the morning. You're looking to see early in the morning how much confidence is. If overnight inventory is long, and the market doesn't correct within a relatively short period of time, and I don't know what that is, then the market's probably going higher. And you're looking how much confidence there is. You're looking at volume. You're looking at the shape of the profile. But there's no exact answer to your question. It is something you develop with experience over time. I think this comes up later this afternoon, but one of the most misleading situation occurs. For example, if overnight inventory is long and you're getting a counter auction, which would be selling, where traders mistake the selling for some real selling, and they don't understand it's just a counter auction to correcting overnight inventory, and they mistake that for new money selling. That is one of the biggest errors traders make. So first of all, you have to be aware of the potential for a counter auction to overnight inventory, and then you have to be able to judge the confidence of the auction. And that's going to mean you got to look at volume, you got to look at elongation, you got to look at where value is going to be building. Where value is building is always going to be very helpful for you to ascertain what's really going on. Okay.
Okay. Um, the duration after which excess is taken out, is that important, or what is the significance of that?
Well, there's no exact answer. A lot of these things, remember, this is art, not science. If you have excess on the upside, you've got selling excess or a selling tail, which would be excess, and it's taken out, well, guess what? The auction may be going higher. That you had no completion to the auction to the upside. Again, it has to be. We showed you an example today where there was no excess on the low for a day, and yet the market went substantially higher. It's one data point. It's not everything. Everything has to be viewed in context. Too many times what people do is they want to take and make everything an action point. And that is a mistake. They're data points. Not every data point is an action point. And we're going to talk about this afternoon, we're going to talk about exponential, uh, using references on an exponential basis in order to bring the odds in your favor. But generally speaking, if the market's going higher and you don't have any excess, the odds of it continuing higher are good. You got excess on the high, as long as that excess holds, then the market may sell off. But you're always watching excess to see, does it last? Okay, what else?
Okay. I've gotten this question quite a bit. People are asking, are the slides going to be made available? No, we do not make our slides available for a very good reason, and that is the explanation and the discussion given in these videos goes along with, the slides, and the information is too important to not have that together. So we really encourage you to review and rewatch the webinars. Okay, another thing. Okay. How do you handle, so this one's a little bit out of scope, but we're right at the end here of the session, Jim. How do you handle counter information? Like, for example, value was overlapping to lower today, and we still had a big move up, maybe short covering. Do you take counter information as a solid piece of information, like something has changed, or do you wait and see how it plays out?
Well, the market, when I look at today, the market was just an absolutely unbelievable drop yesterday. Absolutely unbelievable drop. And the market got horrendously short, and there were a lot of people caught short. And short covering going to go till it's over. But remembering, short covering, when the short covering makes the market go higher. And then a lot of the momentum players get all excited. Oh, their momentum indexes are ticking higher, and they jump on board. And it goes until it's over. So you have to be able to read the profile and, and look what happened to value. Like you're right, today, value's lower right now. And it was such a huge drop. Yesterday was such an unusual day that it's going to be very hard to get even into yesterday's value area. But remember, this looks like short covering this morning, and short covering can do what to a market? When you look at it in total, there's no real meaningful excess on the low, a couple of ticks. This looks to me like short covering. Short covering is considered old business. And so at that point in time, market value is lower, and the market has to always take care of current business first. And if the market is too short, current business is to cover the short. So this day's not over, but right now, value's building lower. There's no real excess down here. We got in past this questionable high yesterday, and no real carry through to the upside. We did not even come close to getting into yesterday's value. So again, you have to go with the punches sometimes, but remember, yesterday's break was pretty severe, caught a lot of people off guard, an awful people caught short late, and you don't have any real excess on the low. Okay, let's say thank you. We'll be back. When do we come back?
Let me look at the schedule properly this time so I don't.
Here, I've got one right here.
Let's see. Let me go find it because I didn't have it up. I thought I did. Here you go. Okay. 12:30 p.m. Eastern time is the next class today. Okay. And just as a reminder for Saturday's class, even though on the schedule it says an hour and a half because we're having a reinforcement of concepts and plotting the market profile exercise, if you're staying for the plotting the market profile exercise, it will be longer than the 1.5 hours stated on the schedule. So just make sure if you're planning to join us for that, or that's important to you, that you basically set aside, I would say, an extra hour on Saturday. Okay. Okay, so we'll see everybody back here in a little bit less than an hour.
Thanks. Bye.